Hey students, welcome back to my channel. This is Dr. Anshika, and in today's video we are going to learn everything about all the theories of capital structure, right? So we are going to learn about all the theories with the help of the examples as well as the graphs. So stay tuned till the end. Firstly, let's understand the meaning of the term that is capital structure, right? So capital structure is what? The foundation or the base, right? And it comprises of your long-term debt and equity, right? It basically comprises of all your sources of finance, okay? Including your debt, equity, reserves and surpluses as well. Clear? There's another term that is known as the financial structure. Okay, now what is financial structure? Financial structure comprises of all your liabilities, including your current liabilities as well, right? In this, we will include our debt, equity, your reserves and surpluses, right? And other current liabilities as well. So this is the meaning of financial structure. I hope you've understood the difference between capital structure and the financial structure. Okay, then in finance, you have studied that all the firms need to maintain some optimum level of capital structure. Why? Because with the optimum level of capital structure, our weighted average cost of capital will be minimum and it will try to maximum the value of the firm, right? So what is the cost of capital? Cost of capital for say debt, it is the rate of interest, okay, and for say your shares, it is your dividend, like what all you are paying back is known as your cost of capital. Clear? Okay, for comprising a sound capital structure, the risk should be minimum and the returns should be maximum. Okay, flexible, the capital structure should be flexible. It should be able to change in the rapidly changing environment. Okay, then capacity, the capital structure should be within the capacity of the firm, like how much the firm can afford, okay, in terms of cost of capital. Then control, what do we mean by control? Supposedly there is a firm that has equity shareholders of say 90%, right? So in this, maximum hold is of the equity shareholders. Clear? Now let's discuss about the theories of capital structure. These are being broadly divided into theory of relevance and irrelevant theories, right? And a few other theories are also there, like pecking order theory, okay, arbitrage theory, so on and so forth. So what does relevance theory says? This theory says that with the increase in debt in the capital structure, right, it will reduce the total cost of capital of the firm. Therefore, there will be maximization of value of the firm, right? And in contrast to relevance theory, we have irrelevance theory, which says that whether you increase or decrease the debt, there will be no effect on maximization of valuation of firm, right? Now the first theory is that theory of relevance, that is net income approach, that was given by David Durand, which says that capital structure can increase the value of the firm and minimize the cost of capital by employing more and more debt. Right? So whenever you increase the debt capital, it will going to decrease the overall cost of the capital, and it is therefore going to increase the value of the firm. Now we have certain assumption in this theory. First assumption is cost of debt is less than the cost of equity. Right? Why? Because in debt you have to pay the interest, which is tax deductible. Right? Whereas in equity you have to pay dividends, which are not tax deductible. Further we have is the risk perception of investor is not affected by the use of debt. As a result, equity capitalization rate and debt capitalization rate do not change with the leverage. That means when you increase the debt, there will be no change in the equity capitalization rate and debt capitalization rate, and there are no corporate taxes. Now let's understand this with the help of the graph. Over here we have degree of leverage, right? And here on y-axis we have cost of capital. So now you can see as and on we keep on increasing the debt, right? Our total cost is coming down. For example, supposedly if we had to pay 10% to equity shareholders and we are paying 5% to the debt shareholders, right? There was an assumption that your cost of debt is less than equity, cost of equity, right? So over here you can see that your cost of debt is less than cost of equity, okay? And if we keep on increasing the leverage, the degree of leverage, that is the debt, amount of debt in the company, the total cost is coming down, right? So this is the formula. V over here stands for the value of the firm, right? S stands for the market value of equity, and D stands for the market value of debt. And for computing the overall cost of capital, the formula is EBIT, that is earnings before interest and taxes, and divided by the total value of the firm. Clear? Now let's understand this net income approach through an example. We've taken an example where a company has a profit of 50,000 rupees and it has debentures of 2 lakh rupees on which 10% of interest rate has to be paid. Besides that, it is given that equity capitalization rate is 12.5%. So whenever you start your question, you always start with your EBIT, that is earnings before interest and taxes. So earning before interest and taxes is 50,000 rupees. Okay. So first thing that you have to do is you have to deduct the interest rate. Right? Interest rate over here is 10% of 2 lakhs. You are supposed to pay, it is compulsory to pay the interest on debentures, right? So 10% of 2 lakhs comes out to be 20,000. So what is left? So whatever is being left is of equity shareholders, right? So these are the earnings of equity shareholders. I hope till now everything is clear. Okay, moving ahead, now we have to compute the market value of the equity shares, right? Or we can say we have to compute the S. For computing this, we have this, the earning that is available to the equity shareholders, that is 30,000 rupees. Okay. And capitalization rate is given to you 12.5%. So, can I compute the value of the equity shares. So this comes out to be around 2,40,000. Right? Now we are going to compute the market value of debentures that is given to us in the question. It is 2 lakhs. So total of these two is 4,40,000, which is the market value of the firm, right? Or we can say V. After that, we have to compute the overall cost of capital. Overall cost of capital, what is the formula? EBIT, that is 50,000 divided by your market value of the firm into 100. So this will be 11.36%. I hope there's no doubt. If you have any doubt, then please comment in the comment section. Clear? Now what we are going to do is, the company has decided to raise the amount of debentures by 1 lakh rupees and use the proceeds to retire the equity shares. Okay, we are increasing the debt. Now let's see whether the overall cost of capital decreases or not and the value of the firm increases or not. So again, starting from EBIT, earning before interest and taxes, we have 50,000, right? Now the debentures are, earlier we had 2 lakhs debentures. Further we have issued 1 lakh more debentures. Now total number of debentures is 3 lakhs debentures, on which 10% of interest rate has to be given. So your interest will be now 30,000. And what is being left? 20,000. That is earnings available to the equity shareholders. Right? And again, the market capitalization was given to us, that was 12.5%. Computing the value of equity shareholders, 20,000 into 1,000 divided by 125. So this comes out to be 1,60,000. Okay. And our market value of debentures is 2 lakhs we had earlier, and now we have issued 1 lakh more debentures. So this is 3 lakhs. Our market value will be 4,60,000. We have added the market value of debentures and as well as market value of equity shares. So now can you see that market value has increased from 4,40,000 to 4,60,000 when we have increased more debt in the firm. Okay. Now let's see whether we have any effect on overall cost of capital, whether it has reduced or increased. Okay, so calculating the overall cost of capital, the formula is EBIT upon total value, right? So over here we have EBIT, that is 50,000 divided by 4,60,000 into 100. Now the value comes out to be 10.9%. Now what have you learned from this? Over here we have seen in this theory that when we increase the debenture in the firm, our overall cost of capital comes down, right? And market value of the firm increases. I hope it is clear to you guys with this help of the example, right? So the next theory of capital structure is net operating income approach. This was also given by David Durand. Okay, so now this theory is completely opposite, and this is the theory of irrelevance, right? So what does this theory says? This theory says that change in capital structure does not affect the market value of the firm, right? So, and overall cost of capital remains constant irrespective of the level of your debt, right? So if I say, if I'm going to increase my, say, debt from 50 to 60% in the capital structure, what will happen over here is that risk of the equity shareholders will increase, isn't it? When I'm increasing the debt, I have to pay certain fixed amount on that, okay, in terms of interest, right? So risk on equity shareholders increases. That is why the market value of the firm and the cost of capital remains constant. I hope this is clear. So in this theory, there is no such concept of optimal capital structure, right? So there are certain assumptions in this theory. First assumption says that market capitalizes the value of the firm as a whole and split between debt and equity is not important. So whatever is the ratio, say if you take a ratio of 50-50 of debt and equity, or you say 60-40, or you say 90-10, okay, so there will be no effect on the total cost of capital, right? The business risk remains constant at every level of debt equity mix. There are no corporate taxes and the debt capitalization rate is constant. We are going to study this with the help of the examples. Now, understanding this with the help of a graph, over here we have is the degree of leverage. That means the amount of debt or debentures, right? And over here we have cost of capital on the y-axis. Now, can you see over here, debt is the cheaper source of finance. Okay, so cost of capital is less in terms of debt than in equity. As and when I am increasing my level of debt, okay, risk of equity is also increasing simultaneously. Risk will increase. When risk of equity shareholders will increase, what will happen? They will demand more returns. More the risk, more the returns. Right? You have studied this in finance. More the risk, more the returns. With increasing the level of debt, what is happening? Our risk is increasing for equity shareholders and simultaneously they are going to demand more returns. When they are going to demand more returns, the cost of equity is going to increase and the overall cost of capital remains constant. Can you see this? I hope this is clear. Okay, now how do you compute the value of the firm? Value of the firm is being calculated by EBIT, okay, that is earnings before interest and taxes, divided by a overall cost of capital, right? And one more thing over here that you need to remember is that the market value of equity, okay, is the residual value which is being determined by whatever is left, okay, from the total market value of the firm minus your market value of your debentures. So residual value means whatever remains after deducting your total market value of the firm minus market value of your debentures. So this is what S is what? Market value of your equity is equal to market value, overall market value of the firm minus total market value of your debentures. Is that clear? Alright. Then we have is the cost of equity or equity capitalization. Now what is the formula over here is that earnings after interest but before your taxes, right, divided by your market value, total market value of your firm minus your market value of your debt, or I can say simply the value of your equity. I hope till now everything is clear to you. Now let us understand this theory with the help of an example Over here, your net operating income or EBIT is 2 lakh rupees and the firm has 5 lakh outstanding debentures on which the cost is 10%. Besides that, overall capitalization rate is 12.5%. Now you have to compute the total valuation of the firm and equity capitalization rate according to this NOI approach. So first thing, what do? We take EBIT, right? That is 2 lakhs. Now from this EBIT, you have to compute the overall market value of the firm. Right? Market value of the firm, what was the formula? EBIT upon total cost or the overall cost of capitalization. So, EBIT is 2 lakhs divided by our overall capitalization rate, that is 12.5%. Right? It is given to us in the question. So, after solving this, the market value of the firm comes out to be rupees 16 lakhs. Right? So, the market value of the firm is 16 lakhs. Now, you have to compute the value of equity. What was the formula for computing the value of equity? That was residual value. Okay. So, after deducting from the market value of the firm, you have to deduct the total market value of the debentures. So, V minus D. So, over here, the market value is 16 lakhs. From this, we are going to deduct the market value of the debentures, that is 5 lakhs. Okay, so market value of equity comes out to be 11 lakhs. I hope till now everything is clear to you. Right? Moving ahead, now we have to compute the equity capitalization. For equity capitalization, what was the formula? EBIT minus your interest rate, right? And divided by your V minus D. Okay, or I can say the value of equity, right? So, EBIT is your 2 lakhs. From 2 lakhs, I am going to deduct the interest. How much interest has to be paid? See, 10% has to be paid on what? Your debentures, that is of 5 lakhs. So, 10% of 5 lakh comes out to be 50,000 divided by your value of equity, 11 lakhs. So, when you are going to solve this, your answer would be 13.64%. Please note down this value. We are going to move further with the further examples, right? So, this value comes out to be 13.64%. Now, what happens? This firm tries to increase the debt from 5 lakhs to 7 lakh 50. Right, and uses the proceeds of the debt to repurchase equity. Now, let's understand over here. Firstly, we have to compute what? The market value, right? Market value, what is the formula? EBIT upon EBIT remains the same, right? Divided by your overall cost of capital. So, the market value of the firm is still 16 lakhs. It's the same. But now the value of debenture has increased from 5 lakh to 7 lakh 50. Right? So, the value of, now in this case, what is the value of equity over here? 8 lakh 50,000. Am I clear? Moving ahead, what do we have to do now? We have to compute the equity capitalization. For equity capitalization, what is the formula? EBIT minus interest divided by your value of equity. So, EBIT is 2 lakhs. Okay, 2 lakhs minus your rate of interest. Right? Now, you have to pay 10% on 7 lakhs. Why? Because your debentures have increased. So, 10% of 7 lakh 50 is 75,000. Divided by our market value of equity shares, that is 8 lakh 50. So, this comes out to be around 14.7%. Right? Now what have you seen? With the increase in debt, the equity or the cost of equity has increased, but market value has remained the same. Market value of the firm has remained the same. Let's take another case where the firm redeems debt of 2,50,000 by issuing fresh equity shares, right? Now the firm has reduced the number of debt. Firstly, we have to compute the market value. Okay, for market value, we need to have EBIT, that is 2 lakhs. EBIT remains the same, divided by what? Our overall capitalization, that is 12.5%. So, market value of the firm comes out to be 16 lakh. So, can you see in all the three cases, the market value has remained the same, that is 16 lakhs. In all the three cases, the market value of the firm has remained the same irrespective of whether you have increased the debt or you have decreased the debt. Okay, then you have to compute the market value of the equity. For this, we are going to deduct the market value of the debentures. Now the market value of debentures is 2,50,000 in this case. So market value of equity comes out to be 13,50,000. Right? Now computing the equity capitalization rate. The formula is EBIT. EBIT is 2 lakhs minus interest. Now in this case, we have only 2,50,000 debentures. So 10% of 2,50,000 is 25,000 divided by our value of equity shares. So this comes out to be around 12.96%. So what have you seen? You have seen that with increase or decrease of your debt, okay, irrespective of with increase or decrease of your level of debt, the market value remains constant. Hence proved. However, the equity capitalization rate increases with the increase in debt and it decreases with the decrease in the level of debt. I hope this is clear to you guys.